Okay, in this video I want to examine again the possibility of a uh, market maker manipulation on the stock movement or the momentum of growth or fall of a stock. We can also call this artificial momentum versus natural momentum. And I want to show you this GMXR chart for today, but when I'm talking about money makers or market makers, excuse me, I'm talking about these accounts up here. See, Fidelity, X-Trade, Ameritrade, Scottrade, and there are many more of these. 100, 200 such companies that are licensed by the SEC to operate spreads, to offer bid prices and ask prices. Now they have to tie their price to the general nationwide selling price or worldwide selling price, if you wish, from the NASDAQ or Amex or New York Stock Exchange. So they can't really fiddle with this too much, but they can help set it by operating their own spreads that they get via their orders. So the bigger one of these brokerage accounts or brokerage companies is the bigger one of these companies is, the more able it is to operate to make profit, because it gets more orders and then it could manipulate the spread more. Okay, now so this opens up with a now you can see the volume down here, how much is being sold or traded. There's an 11,800 trade right away. Now whether it's bought or sold, I don't know, borrowed or sold, I don't. But that's right away. That's just operating with the orders they have. Now they have to start on the red line here because they probably had one order, a limit order, to buy at 53 cents. So they had to start here. But if they knew that the orders they had in line for the next 20 or 30 minutes, one of them was, say, a buy or sell at 46 cents, and a bunch of market orders were in between, they could do something here, all right? So all they need, to drop it down here is for one order to say buy at 52 limit. All they need to get it right here is for one order to say buy at 51 limit. Now if they have a lot of other market orders here, they can do whatever, they can do quite a bit of manipulation. So let's look what happens here. There's 11,000. Right here there's 15,000. There's 3,000 there. That's not much. That's well, I mean, it's something. There's 20,000. That's a collection of orders, and it might also be the brokerage, a certain brokerage firm buying orders themselves. 42,000. So can you see the computers realizing, hey, we're going to drop this price if we borrow and sell right now, and then, in other words, do a short sale. When we get down here, there's 19,000. When we get right here, we can sell them off. So there's a 22,000 share sale. Right here is a, what was that, 18,000. Right there is a 19,000. Now that's a profit if they're selling off shares they bought up here. Right there, if they're selling off 10,000, they get 10,000 here. They sell them, get the money, and then right down over here, buy them back again. They're making quite a bit of money on a short sale. Now look how this just rises, all right? So there's the other possibility that they realize that the orders they're receiving indicates a rise. So they may be able to buy right around here somewhere. Let's see if we can find, there's a big one. Why are they buying 30? Why are people trading 38,000 right there when there does seem to indicate a rise? And all of a sudden you get 48,000 being sold off. Now if you were buying that 38 and then selling, you're making a penny off this. But when you think about it, that's a cool $500 or something right off the bat. And again, it's not that clear cut, but for theory's purposes, we can think of it simplistically that way, just to understand what they might be doing in part. Here's something especially intriguing. Right here is 39,000 trades. Okay, that means someone wanted to sell 39,000 and someone bought, right? Now why would somebody sell if this thing is going up? There could be reasons for that, okay? But if you're a market maker and you have an order, somebody just placed an order to buy, I don't know, 50,000 shares, or you have a collection of orders for 50,000 at price 53, or if you have 50,000 orders to sell at 53, you can buy it up right here and then sell it right here. Okay, so you're making a 2-cent profit. Now look at, see right there, you see 29,000 shares sold? 39,000 sold. So again, not every share of these 39 is going to be bought by a brokerage firm, but I do suspect that a lot of these shares are bought by these firms and then sold right afterward, right there for, you know, if they're making 2 cents, they may make $200, $300 on the trade, but we're talking within a minute. So that's pretty good. That's pretty good wages, $200 a minute. If you can do this consistently, this is only one stock. I mean, these brokerage firms up here are dealing with thousands of stocks. This is only a 52 cent. I mean, this is a great stock. You don't really want. What if you're dealing with a stock that's $520, and you can do this sort of thing? Then it's we're dealing with thousands of dollars profit in a minute. Anyway, something to think about.